Altcoins are rallying, Aleph Zero gets a major upgrade, and STX is up 350%. This is your Altcoin Buzz news. Hey, what's up everyone? My name is Cody Buffington. Make sure to like, subscribe, and turn on notifications so you know when we drop our latest content. Follow us on Twitter at AltcoinBuzzIO, and as always, this is not financial advice, and we wish you the best of luck in your crypto ventures. Bitcoin returned to 28,000 on March 29th as a classic short squeeze took the market to 5-day highs. The quick uptick came courtesy of exchanges where a band of shorts were blown out to remove resistance and allow higher levels to return. As noted by analysts, these shorts were left over from Bitcoin's prior moves and were worth around 1,500 Bitcoin. It looks like the previous bounce was shorted heavily and these shorts just got blown out. According to CoinGlass Analytics, total Bitcoin short liquidations from March 29th stood at nearly $20 million at the time of recording. Bitcoin has added almost 72% to 28,500 this year, its best quarterly gain in 2 years. Just 3 months ago, some experts were talking about the possibility of Bitcoin falling to as low as $12,000 this quarter after its valuation had declined 76% since November 2021. The rebound has put Bitcoin ahead of Ether, the second largest cryptocurrency by market value, which appears to be on track for a 50% quarterly gain. Gold has added over 7%, while the Nasdaq has rallied 15%. The central bank's balance sheet has recently expanded by $300 billion, undoing months of quantitative tightening. According to the Fed Fund Futures, traders now see the Fed beginning an easing cycle in June with a 25 basis point rate cut. Binance's on-chain balance remains high despite U.S. regulators charging Binance for violating U.S. federal law this past week and Forbes' allegations last month. Data from blockchain analytics firm Nansen shows that Binance's on-chain portfolio currently stands at $64 billion. USDT, Bitcoin, ETH, BUSD, and BNB are Binance's largest holdings, making up roughly 81% of the crypto exchange's total balance. The reserves display the asset backing and strength of Binance, which may cushion outflows from the exchange as some fear an FTX repeat. Binance has, as of Wednesday, seen over $600 million in customer token outflows, although the figure is still relatively lower than when BUSD issued Paxos was slapped by a U.S. Securities and Exchange Commission lawsuit earlier this year. Binance processed over $2 billion in withdrawals in a single day at the time. Fundstrat analyst Walter Tang says recent allegations from the U.S. Commodities Futures Commission against Binance and its founder CZ should just be a slap on the wrist. According to Charles Story, head of growth at crypto index platform Future, funds, traders, and investors who have exposure to Binance see the current situation as business as usual. Our partners at Hector Network have just launched their new DEX Hector Swap. Hector Swap is a platform that allows users to swap one token for another on various EVM-based networks, which include Ethereum, Phantom, BSC, Avalanche, Polygon, Optimism, and Arbitrum. Hector Swap aggregates liquidity from multiple decentralized exchanges and provides users with the best available price and liquidity. Hector Swap fetches optimal prices to swap from one token to another and then builds transaction data that can be used to execute transactions on-chain. With Hector Swap, users will be able to explore optimized routes instead of directly swapping from the end user to a decentralized exchange such as Uniswap, Curve, or Balancer. One of the key benefits of using Hector Swap is that it provides users with a more efficient and cost-effective way to trade tokens. Hector Swap is highly efficient and useful for larger transactions, as the aggregation and order splitting feature allow users to reduce slippage when transacting with larger orders. And what better way to control your trades and get exactly the price and rate you need than to be able to set limit orders? Hector Swap features allow savvy traders and investors to set price limits on your orders and swaps. You can check out the new and improved Hector Swap link down below. Ethereum validators will soon be able to withdraw their Ether from the Beacon chain, with the Shapella hard fork set to be activated on the Ethereum mainnet on April 12th. The withdrawals will be enabled by Ethereum Improvement Protocol EIP 4895 by pushing staked Ether from the Beacon chain to the Ethereum virtual machine, otherwise known as the execution layer. While the hard fork will allow for partial and full withdrawals, several mechanisms are set in place to ensure a flood of Ether doesn't disrupt the market. There are now 17.81 million Ether staked on the Beacon chain. At a current price of $17.76, this means $31.6 billion can be incrementally unlocked over time. While the Ethereum Foundation described the latest testnet run on Gorelli as smooth, there was a notable delay in activation time due to many validators not updating their client software. However, Tim Biko is confident it won't be an issue this time, as Ethereum validators will be economically incentivized to make the update for the mainnet. The news boosted native tokens for staking projects like Lido, Frax Shares, and Rocket Pool. The gains across the tokens surpassed Ethereum's 5.5% rise over the last day, with Lido rising 18.6%, Rocket Pool by 13.3%, and FraxShare token by 20.4%. When a user deposits into a staking project, they receive a staked version of Ethereum, which accrues staking yield and acts as a receipt of their deposit. Once withdrawals are enabled, some analysts suggest that this may also reduce the risk of holding these staked versions of ETH. The reduced risk could encourage more ETH holders to stake with LSD platforms for higher yields. STX, the native token of STX network, has soared in March amid booming hype for Bitcoin ordinals and a growing total value locked on the protocol. STX is known for being the first token distributed through the first ever US Securities and Exchange Commission qualified token offering in 2019. STX has gained 23% in March, reaching $1.25, the token's highest level since a year ago. Although the token gains have slowed slightly towards the end of March, it's still up 350% over the last 3 months, bringing its total valuation to $1.5 billion. STX is a Bitcoin Layer 2 protocol for smart contracts that's attempting to transform and extend Bitcoin's functionality from its widely known role as an alternative payment system to a more versatile platform that is programmable. The token began to climb last month amid market participants' growing interest in creating Bitcoin ordinal NFTs. STX has a native functionality to mint NFTs, and users have minted 650,000 Bitcoin NFTs on the STX Layer 2. The STX founder said the hype surrounding STX is definitely due to ordinals, but could be sustained if the devs stick around. Bitcoin needs projects like this to sustain itself in the long run. In a report, North Rock Digital, a hedge fund that invests in cryptocurrencies, wrote that despite limitations developing a crypto economy on top of Bitcoin, STX has a potentially massive opportunity because of the relatively small crypto economy currently built on Bitcoin. Aleph Zero is a privacy-enhancing, proof-of-stake public blockchain with instant finality. Its enterprise-ready, high-performance network is built on a novel direct acyclical graph, or DAG-based consensus protocol that's been peer-to-peer reviewed. Aleph uses the DAG as an intermediary data structure, but can still be categorized as a blockchain. Aleph Zero has just announced that 4.0 smart contracts are live on Aleph Zero mainnet. They said, with this significant milestone, the Aleph Zero ecosystem opens up to run new projects that will benefit from the network speed, scalability, and security, together with the upcoming privacy framework to protect user data. Up until now, users could natively transfer and stake their AZERO on the mainnet while developers were building on the testnet. Today is the day when creativity can break free and all the products can be freely deployed to the mainnet, contributing to the growth of the Aleph Zero ecosystem and utilizing its features that adhere to the ethos of crypto and Web3. The Safemoon token liquidity pool was drained of nearly $9 million worth of tokens on Wednesday after attackers manipulated a faulty feature on its smart contracts. Blockchain data shows several tokens were exchanged in the early hours on Wednesday in a single transaction, with the attacker ultimately stealing billions of Safemoon's SFM tokens locked on an LP. Safemoon's SFM tokens fell over 40% in early Asian hours before slightly recovering. Safemoon is a decentralized finance token that has 4 functions that take place during each trade: a fee reflection, an LP acquisition, a token burn, and growth fund, with these factors contributing to making Safemoon one of the biggest gainers in the 2021 bull market. Safemoon developers said Wednesday that their liquidity pair had been compromised. They said we're taking swift action in an attempt to resolve the issue as soon as possible. Safemoon CEO John Caroni said in a follow-up tweet that the exploit was related to a single LP on BNB chain. Caroni said, "I want to make clear that our DEX is safe. This ultimately affected the SFM BNB liquidity pool. We've located the suspected exploit, patched the vulnerability, and are engaging a chain forensics consultant to determine the precise nature and extent of the exploit." Some developers pointed to a faulty burn feature on Safemoon smart contracts as a key reason behind the exploit. Dapt CEO DeFi Mark posted on Twitter saying, "The attacker took advantage of the public burn functions. This function let any user burn tokens from any other address." That's it for your Altcoin Buzz News Update. I'm your host, Cody Buffington. Thanks for watching.